Is a villa in Bali a good investment in 2024? There are similar questions like, is a villa in Bali a good investment for me, or is this particular villa a good investment? But today I talk just generically, is it a good investment in general in 2024? So what does it mean to be a good investment? To me, it's about comparing with the alternatives, and also does it fit into my portfolio, in my investment portfolio. So not going into all the details and rabbit holes of the modern portfolio theory, but I think you cannot ignore all the concepts altogether. So first, what is it that makes a good investment? Today in 2024, there are a couple of interesting alternatives. In the end, it comes down to what are my options. And today, unlike 2 years ago, 3 years ago, you can get a very interesting interest rate. You can open a savings account, or if that's not an option for you, you can buy some fixed income ETFs and have a, let's say, a diversified short-term duration mix of different bond ETFs, and you get around 5% without risks or nearly no risks. And you can sell it pretty much any day or access your bank account on any day, or at least every work day. So you have liquidity anytime you need it. You have just about no risk and you get 5%. That's pretty good, and that was not available about 2-3 years ago. Now that's one key benchmark, and to me that means if an investment gives me less than these 5%, it can hardly qualify as a good investment. Another all-time favorite of mine is an S&P 500 index fund. So historically that has been an average of 10 to 11%, but the volatility is quite high. And I think we all still remember the early days of COVID-19 when there was a bit of a stock market crash, and I think the downside of that in this scenario was more than 30%, close to 50%. And when you have all your savings in a S&P 500 index fund, and suddenly half of your savings or close to that are gone, or your running expenses continue to pile up, that can be quite a bummer and really bad for your mental health and of course your financials as well. So the volatility is the big issue on the S&P 500 index fund, and of course there's no guarantee for anything. You get a payout on dividends of maybe 1.5–2%, and the rest is an increase in the value, which can be actually very good tax-wise. And of course, it's up to you if you sell parts of it or if you use it as a collateral for loans, which is also a very interesting option. So these two, to me, are key benchmarks to compare any investment with. S&P 500 index fund, high volatility, can be really bad on the downside in the short run, but in the long term it was always an awesome investment with great returns of around 10% annually before inflation, but we leave inflation out for all of these discussions here. Inflation is, if you leave it out in all options, you can just compare them on an even playing field. So here we have high liquidity, I can sell it at any point of time. High risk, yes, and very high volatility as well, but great returns. Now coming back to a villa in Bali, here of course every villa is different, but nevertheless they give you a return, or to be precise, return after your depreciation of your leasehold value, of a range of 5–9% or maybe 6–8%. Of course, some are much better, some are much worse. Some barely cover their operating expenses. some have negative return really. But in general, if you go fairly mainstream with your investment choices, you would get between 5 and 9% on most years. So let's assume something in that area. And that means it's better than a savings account, return-wise, but not as good as a S&P 500 index fund. However, that's just looking at the returns. Now, when it comes to volatility and risk, that's very different. So in terms of volatility, you also have a high volatility, not quite as high as S&P 500 index fund. You have better years, you have years that are not so good. You might have some big maintenance that kills down a lot of your returns, or you have some earthquake or floodings or pandemics or volcano eruptions that really impact your returns as well. So you have high volatility, similar to S&P 500, returns probably slightly lower. It is better than a savings account, even though not that much, and not all villas are. So if liquidity and immediate access is important to you, then a savings account is probably better. You do get a bit more return, a couple percent most likely. Why do you pay a high price for that? You take a lot of risk and your money is not accessible. Selling your villa is something that might take years. So that is something that's not for everyone. And this not for everyone is a very important factor. A villa in Bali is not just pure financial investment. It can be seen as a hobby. It's something where you might want to spend your own vacation in. It's something you like to have, you like to spend time in. So these are other aspects, but let's focus on the investment. So it's between a savings account and a S&P 500 index fund. It's not as golden as the salespeople want to make it look. Now let's look at the portfolio aspects of your investment. You have a portion of your funds allocated in a S&P 500 index fund. You have something for immediate expenses in a short-term available bond funds or money market funds or savings account. And then, of course, you want some other aspects that balance out the volatility of your S&P 500 index fund. So the investment in a Bali villa gives you also high volatility, but it does not exactly correlate to the S&P 500. So when there's a massive downturn on the stock market, your investment in Bali might still go up or still perform well, and vice versa. So this low correlation is one of the key factors, purely from an investment point of view, that make a villa investment interesting. So balancing these out and have a portion of your assets allocated to real estate really evens out the massive volatility impact of the equity exposure in your index funds and can make an interesting addition to your portfolio from an investment point of view, and only look at the numbers. Leave the emotional aspects aside, leave the impact on your personal life aside. You want to spend time in, you see it as a hobby, as something you like to do, or you learn, or you spend time with your family and friends in. So purely of an investment point of view, portfolio theory is the key here, and it can balance out the impact of your volatility in your equity investments. So having said all that, there are other reasons to invest in Bali than purely the financials, but it's also very important to understand real estate investment in Bali is not as good as it looks when you just look at the marketing brochures of the developers. So always keep that in mind, stay open, and always remember they're not all the same. As I mentioned, it's a range in which most villas in Bali perform financially, but the reality is very, very broad. You have fantastic villas, you have very bad villas, and it's unbelievably hard to determine beforehand whether your actual villa investment will be mainstream, will be fantastic, will be poor. And of course, it will have good years and bad years. So if you aim for the mainstream, that also means your investment will be fairly mainstream. Let's say Canggu, Uluwatu, maybe Ubud, and not overly fancy or extravagant. So with these, you probably end up in the mainstream, and that makes it a lot more predictable. Let me know what you think about the portfolio management aspects of a real estate investment in Bali, and follow for more analysis on the Bali real estate investments.